Hello and welcome to Innovation Women Speak webinar series. I'm Bobby Carlson. I'm the founder of Innovation Women. Innovation Women is a visibility bureau for entrepreneurial, technical, and professional women. We connect women with speaking opportunities, and we connect event managers with awesome speakers who just happen to be women. Our mission is to eliminate the all-male, all-pale, and all-stale panels you see at so many industry conferences and events. And these days, we have lots of virtual opportunities and speakers for your next online event, too. Innovation Women is a platform that addresses both sides of the conference and event industry. We have speakers seeking visibility opportunities and event managers who are using it as a one-stop shop looking for speakers. Innovation Women is much more than an online speakers bureau. It's much more than a traditional speakers bureau. Event managers can search the database for free, and speakers pay just $100 a year to become a member. Here are some features of our site. Event managers post calls for speakers, and speakers search and apply for those speaking opportunities. Both sides can manage their applications and invitations on their dashboard, and we have robust keyword functionality for searching for speakers and opportunities. If you are interested in joining Innovation Women, you can do so today. You can use the code IWWebinar, that's all in capital letters, for 20% off your first year of membership until midnight tonight. And we are getting our speakers for our webinar series from our own platform. So our webinars are themed each month, and we post the call for speakers on Innovation Women. If you're interested in hosting one of your own webinars, apply on the site with your proposed webinar talk. The deadline to apply to the May 27th webinar on mental health awareness is April 27th. And just a quick promotion of our next webinar, which will be May 13th. Before we get into today's presentation, I'd like to give you the chance to register for our next webinar. On May 13th, Aileen will present Stress Less, Sleep More, How to Create a Calming Quarantine Routine. You'll learn some of the psychological reactions that quarantining can elicit in the mind and body, and specific strategies to address stress and sleep from multiple angles, including nutrition tips, technology usage hacks, and mindfulness exercises. It's also a way to make small but impactful changes that can last no matter what your life looks like. And you can register for this webinar in the attachments tab. Speaking of which, this is an annotated version of your screen. Below the video viewing window, there are tabs. The default tab is Ask a Question. You can type in a question or a comment at any time during the program. The Attachments tab is where you'll see documents and links from today's speaker and the link to sign up for our next webinar. You can download the attachments at any time during this webinar and from the recording. The tab called Rate This helps us determine what you like, and we read all the feedback, so let us know what you think. The tab that says Vote allows you to vote in today's poll questions, and we have a number of polls. Somebody's already asked, what was that code again? It's IWWebinar, all in capital letters for using Innovation Women or joining innovationwomen.com. Today, you can also enlarge your screen to view it in full screen mode. And if at any time you need audio help, feel free to click on the Help button at the bottom of the screen. Today's webinar is being recorded, so if you'd like to view the webinar again, you'll be able to do so through the link we send you in an email after the webinar. So now, on to today's presentation. With us today is Lana Carter. Lana is an innovation entrepreneur, creative deal-making lawyer. She's hailing from the Midwest, residing in the greater Boston area, wielding business and legal acumen while leveraging hard-won wisdom to drive success. She is a counsel at Darov and Associates USP LLC outside of Boston and helps businesses and individuals navigate their way through regulatory, compliance, dispute, contract, and public relations issues. We are very excited to have you today with us, Lana, and I will turn things over to you.
Thank you so much for that introduction. I'm excited to be here. So today's topic is really about learning to ask smart questions about financial statements, specifically the balance sheet and the income statement basics. You might have noticed by the introduction from Bobby that I'm not an accountant and I'm not practicing right now as anyone's lawyer. So all of this, I have to give that legal disclaimer that this isn't legal advice. This is just my experience and trying to share that with others. So hopefully others can make smart and wise decisions as they grow in their careers. So today's takeaways are really going to be focused on understanding the interplay between a business's balance sheet and an income statement, and then learning how these accounting reports or these financial reports ultimately will inform an investor or someone who's looking for investments in their business on the overall health of the business. And ultimately, because presumably most of us on the phone today and at this presentation are not finance gurus, we need to be able to look at these financial statements and suss out what is awry with them. Why are certain things that way? So when we don't know everything, that's okay, as long as we know how to ask a smart question that will ultimately serve to reveal what we need. So that's really the focus of today. So what is all the fuss about, right? According to the Federal Reserve Bank in a 2017 study, over 60% of businesses were seeking some type of investment or credit opportunity for their business. And I think we can say that that percentage with a great deal of confidence is much higher today and will be throughout the year 2020 and into 2021 as a result of the COVID-19 crisis or pandemic. We can see that a lot of businesses are going to be looking for investment opportunities. And if you are one of those people either serving in a role that needs to analyze this information for your own company or are looking to invest in others, then you're going to want to be able to have some type of familiarity with the traditional balance statement and the income statement. So turning right now then to the most specific and most obvious financial statement is the balance sheet. So the balance sheet is probably the most popular financial statement that any of us are going to see especially in small businesses or when we're looking to refinance a company or seek out a small business loan, et cetera. The balance sheet is really important because it's going to show you how a company is doing at a specific moment in time. And that's really key because if you look at the balance sheet in month 1 and look at it again in months 2, 3, 4, 5, and 6, you'll start to pick up on trends to see how well a company is doing overall. The balance sheet is predominantly comprised of 3 different sections: assets, liabilities, and equity. And you know, they say the old joke is you go to law school so you don't have to do math, but I think that this is one of those equations that we just can't ignore. It's too critical. So whether we like math or not, we really need to get comfortable with this concept that assets, the total value that a company has, is equal to the liabilities, the debt, if you will, the amount of money going out, versus the equity, what we have at the stake in the company. So the balance sheet basics. The balance sheet basics, again, the assets. This is the total amount that a company would own at any given time within the company. And the liabilities is going to be that outstanding debt and obligations, the equity being the net assets of the owners of the company. And that would include the amount of unowned unowned assets that are from the debt holders. So your typical balance sheet is going to be contingent on and what it looks like, contingent on any specific business. Always you'll see the company name at the top with the date, because again, the balance sheet is a snapshot. It is a moment in time of what the company looked like financially in terms of assets, liabilities, and equity. So don't be alarmed if you see certain companies that don't have all of the subparts to the assets, liabilities, or equity. Some companies are not going to have land. Some companies will not have the same type or level of inventory that others because the nature of their business doesn't support it. What's critical to understand is that they do need to have, obviously, these three major components: assets, liabilities, and equity. So assets is typically divided into current assets and non-current assets, the things that we own now versus the things that will be owned over a period of time. Then there's also the trading assets, accounts receivable, inventory, and your property, plant, equipment. Again, these will be the subcategories underneath that asset category, typically on the left-hand side of your balance sheet. So one critical component of the left-hand side of the assets is a little section called goodwill. It's identified on the balance sheet, but it's often really intangible. It's something like the brand reputation. It is the amount that we'd be willing to pay above and beyond the fair market value of something. So if the company's value goes down, then the goodwill is usually written off. And we'll talk more about the significance of goodwill throughout the course of this presentation. Next, turning to the right-hand side of your balance sheet, there is the section of liabilities, and it too, just like the assets, is separated into current liabilities and non-current liabilities. Current liabilities are going to be things that can be paid off within a year, typically, and non-current liabilities will be something that takes a much longer time to pay off, things like loans or bonds, things like that. Liabilities, just like assets, are separated into even more subcategories. These include things like debt, accounts payable, accrued expenses, under-earned revenue, and deferred expenses, or deferred taxes, rather. So this is really important to recognize that accounts payable and accrued expenses are not the same thing. Accounts payable, right, we can think about as including the company's IOUs, the things that we have to pay out. Maybe that would be employee salaries, for example, versus accrued expenses. Those are those expenses for services that a company has already used but not yet paid. You're making payments on them over time. They're very similar, but they're not the same. So if you're seeing them as the same on a balance sheet, that should give you pause and make you question what is happening right there. Moving on then, in the liability section, you will see a category for unearned revenue and debt. Now, the revenue that has been collected is revenue that's been collected but not yet provided. That cannot be recognized as revenue because the service has not yet been provided. Think about something along the lines of subscription services, right? That's an instance where we will be offering something over a period of time, but we only get paid on a monthly basis. The difference here is that the debt will include those short and long-term IOUs, the loans from banks, repayments to investors, etc. So the equity is usually on the lower right-hand corner or the lower right-hand section of your balance sheet, and that includes the total net asset value. It is the paid-in capital, the amount that the investors are paying in to the business. And it also includes the retained earnings, right? The measure of earnings a company uses to reinvest in itself. So just because you're making money doesn't mean that you're going to take it all as profit. We usually reinvest it and infuse that into the company. So this is important to remember. A balance sheet should always be in balance. So that means that that initial equation that we talked about has to equal out. And that is really critical, especially if you're doing this by hand. Most of the time, in fact, 99.9% of the time in the modern era, this is done by a professional bookkeeper, your QuickBooks, or something like that. But if you're seeing a balance sheet, it's not in balance, something is awry. But a balance sheet is not an income statement. The income statement is spoken about synonymously with the balance sheet because they are intertwined. And the income statement is also known as the P&L, or the profit and loss statement. Now, this is often considered very mysterious. A lot of folks I have met, certainly clients, have some initial concern about thinking about the P&L statement. It's some big, mysterious financial statement. Again, I want to remind everyone that if you haven't gone to school for this or worked in the industry for a while, not the time to be intimidated. Learn and ask the questions about what's in this. So profit and loss statement, if you don't know what it is before now, hopefully we will explore a little bit about what is entailed in that. So thinking about the income statement and the balance, the income statement and the balance sheet, we need to think about how they are intertwined. And within the equity section of the balance statement, that will have to match the earnings of the profit or the loss reported in the income statement. So that's ultimately how they're intertwined. The income statement is comprised of the revenue, expenses, and profit. And that probably makes sense to most of us, where the revenue, the money that we're bringing in, minus our expenses, equals our net income, the amount of money that's ultimately sustained. So when we think about this, then the income statement will help identify the risk and opportunity for a company, and it can be used to forecast future performance. One of the key distinctions between an income statement, which is going to be over a period of time, usually a quarterly or semi-annual or annual basis, versus the balance sheet, which is at a specific moment in time, is the different types of trends that it will reflect within a company. It's typically used by investors and competitors to see how well their competition is doing, creditors and owners, because it's going to determine how well and how easily a company can pay back on its debt. But the income statement, like all of these statements, does have its limitations. So it's based on assumptions and estimates. Some estimates for items, for example, might be highly relevant but intangible or difficult to measure, things like human capital. If you are a company that is contingent on a superstar employee, that can be difficult to measure versus a widget for a widget selling company. So the income statement only reflects the activities and sums that can be objectively measured, but even objective can become more of an art than a science. And we'll talk a little bit about that in just a moment. But remember that the income statement is also heavily tied to our inventory valuation. So most often we're looking at these statements and we have the information, but and my clients ask me, okay, so what's the point? I've got these statements. I'm not a finance guru. What's the point? I still need to know whether or not I'm in a good position to seek investments, or in instances where we want to acquire an entity, whether or not that this is a good investment. And I think this is a good time for that first poll, Bobby, if we haven't already initiated that. And how comfortable...
We did initiate that and got some actually really good feedback on it as well. So the majority of people don't feel confident in it.
Okay. Yeah, right, good. And that's fine, right? Because we can't all be subject matter experts, but what we can do is figure out when something is off. And if it's off, it begs the question. The number one issue I have seen time and time again in helping my clients who are newer to this is when you don't ask a question. And usually that comes from a fear of maybe embarrassment of asking a dumb question, et cetera. Well, I have a take on this, and maybe this comes from that wisdom part of life. But my take is ask the question, because you're going to get one of two responses. The person is either going to answer the question or they're going to give you the runaround. And both answers are informative. If someone answers your question, whether or not it's perceived as stupid or not, that's their perception, not yours, first of all. So if they're going to be condescending about it, well, then that's information for you too. Do you want to go into business with someone who treats you like that? Conversely, if they give you the runaround, do you want to go into business with them? So ask the question. Remember that when you ask the question out of a sense of curiosity, you deserve the respect of having a negative response. So regardless of what the answer is, it's just take, but ask the question. Because what we have found, what I personally found, professionally found, is that when you ask the question, there is a reason why we're asking these questions. It's so that we can learn and engage more about the investment strategy of a company. So one of the things that we want to look at first and foremost when we're in the boardroom, maybe for the first time, or when we're looking at investments opportunities for the first time, is who prepared this? Was this substantiated after it went through QuickBooks? Was it prepared by an outside firm? Was it prepared by the in-house bookkeeper who doesn't have much invested in the company and wasn't asking questions about who was feeding the numbers to the bookkeeper? Was it prepared underneath GAAP, right? The generally accepted accounting principles. This is a rule-based approach. It's very common in the U.S. and U.S. businesses. For international businesses, the IFRS, or the International Financial Reporting Standard, a more principle-based accounting and accrual-based system, will definitely speak to the validity and reliability of an income statement versus someone who is not using one of these more fundamental accounting standards. So consider this. You're in the room, you're looking at the balance sheet, you're looking at your profit and loss statement or your income statement, and you're thinking about the assets, debts, and equity. You're looking at the assets section. Again, this is going to be the left-hand side of your balance sheet, and it shows that there's more cash on hand. The question you should be asking yourself is, do you know where that cash is coming from and how it's going to be used? Is that money that the owner, whether it's you or someone else, is looking to reinvest into the company, maybe for research and development, improvements, more inventory, or will that cash on hand be used to pay off debt or maybe even pay off payments, profit payments to the owners and investors? Around the same time that you're looking at the assets, make sure you're looking at the debt and the equity, or the liability and the equity section on the right-hand side of the balance sheet. If a balance sheet is showing excessive debt, why? If this is your own company, you need to be able to answer that to anyone who is looking to invest in your company. They're certainly going to want to know, what are your plans to pay down that debt and how long will it take, right? If you're looking to invest in someone else's company, whether it's the startup down the street or a friend of the family, you're still going to want to know, what are the plans to pay down that debt? And where is that money going to come from? How long will it take? What tools are going to be used? So again, you're looking at the liability section of your balance sheet. It shows a lot of debt. That should beg the question, why? And if you don't know, that's a very valid question. It's a smart question to ask. Now, when we're looking at the equity section of our balance statement, we should definitely be contemplating how much of the earnings have been retained for the company and not paid as dividends. Now, that's just another fancier way of saying how much is being reinvested versus paid back to the investors, and why. Again, valid questions, things that we're going to want to know. So let's go back to that goodwill. When I was first looking at the goodwill section of the balance sheets, I was really confused. And I have found that since my confusion, I have seen a lot of clients also find that the goodwill section of your balance statement is more of an art than a science because it's so heavily tied to something that's intangible. Remember that goodwill is the difference between the price paid for an acquired entity and that sum over and above the fair market value of the identified net assets. So when you see the goodwill, if it's not explicit, not explained in a financial report, or the number seems very high or very low, that's a good way to ask. That's a smart question to ask. What is going into the goodwill that allows the number to be what it is? Who calculated it? How was it calculated? Why is the value so high or low? And is it expected to increase or decrease over the length of your investment? And why? Goodwill is a catch-all, but it isn't. It's a catch-all in the sense that it's going to be capturing some intangibles, but it's still an aspect of the balance sheet that really requires an art and a science. There needs to be actual objective data that goes into that. So if you're looking at the goodwill, you can always ask about that. So I think right around now is a good time to think about our second poll question. So please take a look at that.
That has been activated. You're all set.
Excellent. Thank you. So when we're looking at the financial statements, and by the way, I think this is a good time to talk a little bit about semantics. For those of us who are exposed, are working with, but are not seasoned accountants and investors, right? And we hear folks say finance versus finance. Now, I'm originally from the Midwest, so sometimes my accent does come out, and I will, without even being aware of it, call everything finance. But the truth is there is an actual distinction between, and someone is not being pretentious when they say finance. Okay, so finance is the noun. We are studying finance, right? But when finance is used as a verb, when we're financing our business, that's when you get the I sound in there. So there's your Jeopardy answer for later tonight on the difference between finance and finance. But when we're looking at our financial statements, and now we can use the right words when we're talking about them with our potential investors or creditors, we can start asking smart questions. Things like, does a company have enough cash on hand to pay its bills? And if not, what are the plans to be able to do that? How long will it take? What tools are going to be used to do that? Certainly larger corporations in particular often have strategies to pay down bills over time, and they use very complex mechanisms to do that. Certainly, conversely, the startup company probably wants to be more liquid. That is, they want to have more cash on hand to actually pay things off in a very timely basis. So also think about this when you're looking at your profit and loss. Also, again, remember that profit and loss is your income statement, or when you're looking at your balance sheet, is the company well managed in terms of collecting debt? One of the biggest problems small and larger businesses alike have is collecting the amount of money that they are owed. So typically a well-managed company is able to collect their debts on a timely basis. So if you're seeing an increase in debt, that's also something that you need to look at, is how well managed is the company, because that should be something that's certainly explained. Another question that you might want to ask is, have the owners invested enough money in this? Why or why not? Do they not believe in the company? Do they not believe in the leadership of the company? Or maybe they're looking to invest at a later time. And if they are looking to invest at a later time, why? So another good question for you to consider is, who's investing, when are they investing, and what is the timing of that? Certainly, another question to be asking when we're looking at equity is, how much is an owner reinvesting versus drawing out? This is going to be really critical because, yes, we all want to play with the money that we're earning, but if we're not reinvesting in the company, what does that say to the long-term trajectory of the company, whether it's research and development or new technology. Things like that need to be sussed out for you to feel comfortable with the risk that you'll be taking on, either if you're seeking investments or looking to invest in another company. Obviously, the net worth of a company, overall, how well is it doing, that also is going to be a good question for you to ask. And then, if you were to Google, what do I have to know to look into the wealth of and health of a company, you're going to hear a lot about ratios. Certainly the number one ratio that all financial experts and your lawyers will hopefully be able to speak to are the asset to liability, how much money is being brought out versus how much money are coming into the company versus how much is going out. Obviously, you want more coming in than going out. So avoid being duped. Right? You're not asking a stupid question if you're asking a question about what's in the financial statement or the profit and loss statement, so in your balance sheet. And before you even go that way and get intimidated and not asking a question, remember that fraud does happen. So that's why it's a legitimate reason for you to ask the question. Before we go accuse, we want to remember that it can be unintentional, be completely accidental, and it can be explained in many instances by how certain things are categorized and valued. So certainly things like inventory, how are we appreciating them, depreciating them, amortizing them over time? Hidden liabilities, these are instances where if they are in fact hidden, that's a red flag that something is wrong. But remember that strong corporate governance will ultimately minimize this risk of fraud. So and think that there's some type of fraud, but ask the question, really to it and figure out whether or not something is awry, and ask the questions about how things were calculated. And that will more likely than not allow you to ask not only smart questions, but feel more comfortable with the overall wealth of the company. So what to do now? You have your balance sheet and you have the related metrics and everything seems to be going okay. But we still don't know what to do. The truth is, that's okay. That's when we need to ask folks who know the subject matter a little bit more in depth than we do. And ultimately, it's important to ask the questions, to do your due diligence before you start investing or reinvesting in other companies. Certainly, with the COVID pandemic, companies are going to be faced with risks that are unfamiliar to them. Certain companies, by design, are going to be more apt to weather this crisis than those smaller businesses in particular that might not be equipped to do that. Certainly, if you see a balance sheet or a profit and loss statement that's continuing to pay dividends and the debts are increasing, ask the questions, why is this happening? Is this something that I believe I should be investing in further, or do we need to change up who's making those decisions or the amount that's being reinvested versus paying off those dividends? And ultimately, now is the time to look for strong balance sheets, right, to figure out if a new opportunity is available to us, and to think about whether or not the company is appropriately capitalizing on, for example, the crisis. Some companies cannot. They absolutely cannot. They've been shut down by the government, and other companies will have an opportunity to capitalize on what's happening now and to be able to shift their strategy. So look to the agility of a company. Again, you want to feel good about the company, whether it's your own company or someone else's that you're looking for these investments in. So think about these things as well. So how are we on that last poll?
So we've done 2 polls, And
Yep.
what we can do is we can open up the last poll, and that question is, how confident do you feel in your ability to ask smart questions now about financial statements? So we'll leave that open during the Q&A period, but we got some interesting answers on the other polls as well. So people can answer that last poll. And are you ready to take questions?
Yes.
All right, because we already have a few.
Excellent.
One of the questions was, at a suitable moment in the presentation, well, question period, I guess, is suitable, right? What are typical amounts for small business loans and grants?
Right. So it depends. That's not a fun answer, but it really does depend. And it depends on the type of business. It depends on where you're looking to get the loan. If you're looking to the government versus a private institution, a private investor. Remember that, your typical loan or grant is often through a bank or the Small Business Association, but there are other institutions that give them. So it really does depend. It could be hundreds of dollars and it could be thousands of dollars. And, I think if you're looking for an infusion of cash, think about what are your needs? What does your business need to thrive? And that's where you can start your inquiry and start to figure out which small business loans or grants are best for your company.
Yeah, I think right now one of the things that's going on is the PPP loans are approximately 2.5 months of employee salaries and such. And so, that's actually, it felt to me like it's a good yardstick.
It is. So certainly, right, it's a good yardstick. There's, I think, over $2.5 trillion being set aside for that. But remember that there are other organizations, too, that are making these loans and grants available. So think about, what are your debts? What is the time frame that you need to be able to pay them off? Certainly that would include salaries, et cetera.
Okay. We also have another question that's specific to the webinar, and do we offer SHRM or HRCI credits? I'm afraid we don't. Just valuable information, folks. But we do have some other questions here as well. Another question we have is, do you have any advice about raising investment money in this environment?
Yes. So, I would say if you are a smaller business or a startup in particular, raising money first, do your due diligence. Get your own financial statements in order and be able to answer and ask the questions that we talked about today in the webinar. And then from there, think about who would most be interested in investing in your company. There are certainly folks who are do-gooders out there, and they are social impact investors who want to invest in companies that are doing good things for the community. And then there are venture capitalists who are motivated by any number of things, and they too might be interested in investing. So now's the time to get your financial statements in order, figure out who is most likely to be interested in investing, and then start to reach out to those individuals or organizations. And, certainly another thing to think about is whether or not you have a pitch deck that is some type of elevator pitch or even a slideshow presentation or bullet points on why someone should give you or your company money. And I hope that helps.
Yep, great. That sounded terrific. Again, folks, if you have a question, drop it in the Ask a Question tab. Next question is, other than assets to liabilities, what other ratios do you suggest we pay close attention to?
Yeah. So assets liability, that's one of the biggest ones, right? Because that is important for us to determine how well a company can pay off its debts. But the current ratio is also really important. That is going to be, again, basic math here now, that's your current assets divided by your current liabilities, and that will give you a ratio, and that will tell you the relationship between the two, right? So 1-to-1 ratio means that there's no working capital, and working capital is the amount of money that we need to sustain a business. So certainly the current ratio is going to be one of the more popular and important ratios that we think about. Another thing to think about is the average age of inventory for companies in particular that sell widgets. How they are quantifying the inventory and valuing them over time is going to be really important because it plays such an integral role in the balance sheet. So the average age of the inventory is ultimately the inverse of the inventory turnover rate, and that's how often we're able to get the product into your business and off your shelf. So that's another really important ratio to think about as well. And certainly the cash conversion cycle, how able is a company to convert its assets and its outstanding resources into cash on hand. So definitely look at your cash conversion cycle and the amount of cash on hand.
Okay, next question. What are some red flags to look for in the P&L and balance sheet that might be masking an existing or looming problem?
Yeah, so that's a really good question. Red flags are going to be certainly when in a balance sheet, if you have them over time, if you see a sudden spike in debt or a certain spike in cash and you don't have an explanation for that, that could be an interesting question, right? Why is there this spike in debt? Obviously, with COVID-19, if we see that, that makes a lot of sense because so many businesses are shut down and people aren't able to bring in the revenue to pay off the debt. But if we were seeing that before COVID-19, that could be indicative of a much more significant problem. And then red flags in the profit and loss statement or your income statement, that's always think about the equity, right? And how much cash is on hand. If numbers are looking awry and they're not consistent with the numbers and the trends that you're seeing in the balance sheet, then that can be indicative that something is off and begs additional inquiry for you to figure out whether or not you want to invest in that company.
Our next question, can you briefly discuss differences between product versus services statements?
Yes. So remember now, I'm not an accountant. So with that caveat, and I have to come from my own lens. So a product statement is going to be focused more on the widgets, right? So how much does your widget cost? How much does it cost to stay on your shelf versus how fast you can get it off of your shelf? How much is it depreciating over time? So depreciation is the amount that you're reducing the value of something for a tangible asset, so your product, right? Versus your service statements, think about your subscription services, maybe the impact of human capital, of those more intangible services that are being provided that are literally less tangible. It's going to be a service. Maybe it's a help desk service or a consulting service. So that is going to be focused on from an amortization aspect where you will figure out how to, something like patents in particular, how to depreciate the value of that service or increase the value of that service over time. And obviously what's going to go into that will be contingent on the type of product or the type of service that's being provided and that whole overall economy of scales, if you will, of that industry. So certainly a drug that, maybe for years I'm going to think of Tylenol, right? So Tylenol for years is going to have a pretty steady valuation. COVID-19 may have spiked that for a certain period of time. Reading mental health services, online services, they were really steady for a certain period of time, and now they might be positively or negatively impacted by the current crisis. So those are going to be the most basic differences is how you value them and what goes into them. Again, products focusing on a tangible inventory like products versus a service, which is less tangible.
Okay. If I'm reviewing my company's balance sheet, to whom should I direct my questions?
So I would first start with who prepared it, whether it's you or QuickBooks. If you are in a larger company where there's a chief financial officer, I would certainly go to them or their right hand and ask them the questions about what they think is important or not important, or where they got the information. Remember that your chief financial officer in a mid to large company, though, is not necessarily the bookkeeper. They are the people who are approving the statement, but they're being fed some of the values that are going into it. So the person who's counting the inventory on the shelf and comes up with that number is not necessarily the same person who is depreciating that and plugging that number into the financial statement. And that person is not the person who is managing it, leading the initiative, and discussing that with the C-suite. So who do you ask? It depends, but more often than not, it's going to be the people who prepared it and how they came up with those values. So everyone from the inventory folks all the way up the chain.
All right. Our next question is, I don't have a business or finance background. How do I establish myself as a go-to person to help with business decisions in my company in terms of analyzing financial statements?
Right. So, I think it's really important to remember that you don't have to have a degree in something to know enough to ask an important and vital question. And if that weren't the case, we wouldn't have folks like Bill Gates and Facebook's founders, et cetera. So remember that taking your own initiative and learning the basics, start with going online, figure out what's most interesting to you, and then head to your library or your online resources to start digging into the areas that are most interesting to you. And then when you go to work, if you really want to get interest, if you really want to become more invested in that, invite yourself to the table, so to speak. Certainly ask the questions, show an interest, and maybe even offer to do a project, a supportive project, so that you can get your name in the hat and be more associated with these financial analyses that your company is undertaking. And that can be a really great way to help develop you as the subject matter expert, even if you're not on the finance team of your company.
Great. And we have one more question. Somebody was saying, this moved really fast. Will the slides be available? You will all be getting the copy of the recording, so you'll be able to look through these and hear Lana's explanation. So you will be able to see that again. You'll get a follow-up email on that. And with that, any last tips or things that we should be thinking about, Lana?
Yeah, I think that, if you are in a position where you're looking for investments for your company, think about whether or not you are prepared to answer some of the basic questions that we talked about today. And if you are, then you're in a much better position to secure the investments that you're looking for. Conversely, if you are less confident in answering those basic questions, be prepared to have some maybe more challenging conversations with the individuals or companies or groups, organizations, et cetera, that would be investing in you. And I would say that advice really speaks to a non-COVID era. Right now, the government and the SBA in particular are working really hard to make the ability to get these loans and that infusion of cash into your company more accessible. And then I would say if you're looking to invest in another company, certainly review their financial statements. Look at the leadership board and make sure that you feel confident that the folks who are in charge are able to address the questions that you have. So whether or not you're looking to invest, again, in a very lucrative or a true out-of-the-garage startup, think about whether or not you'll be able to envision a balance sheet, a profit and loss statement that can answer the most basic questions that we asked today.
Great. That was incredibly helpful. And don't forget, folks, we're going to shut things down now, and definitely give us feedback and let us know what you think, because these are always super helpful as we schedule other Innovation Women Speaks webinars. So thank you again for joining us today, and we will talk to you all soon. Thank you very much.